But here we have 3 emerging managers. Sometimes I use the term young managers, sometimes I use the term emerging managers for this panel. I think here we're going to definitely use the term emerging managers. You have to, you have to imagine these sort of caterpillars slowly creeping out of their chrysalis and turning into butterflies, as all 3 of you I think have recently started funds, and we're super excited to hear about it. So just to kick things off, why don't each of you briefly introduce yourself? And the question that always interests me the most is, when was that aha moment where you caught the investment bug? So Simon, why don't you go first?
Okay, so I'm Simon. I'm 38 years old. I live in Copenhagen with my wife and my 2 children. My interest in investing started quite late, actually. I have a little bit of a different background. So after high school, I started doing stand-up comedy and was actually quite successful in some way. I was on TV and on a national tour. Very popular among cannabis-smoking high school students, extremely unpopular among everyone else. And then I studied theology at the University of Copenhagen. But then I realized after a couple of years that this path had been like a major mistake. And then I went to business school. And one day at business school, I was at an event where I saw a presentation that was sponsored by the Novo Nordisk Foundation. And then coincidentally, a couple of days later, I saw a job advert for Novo Holdings, the firm that manages the investments of the Novo Nordisk Foundation. And I applied for it, and I got a job, and I stayed there for 10 years. Mm-hmm. But I would say that my interest really started because I had some really cool colleagues that got me hooked on this reading all these investment books, you know.
Yeah.
So quite similar to somebody who's just like, not in the investment industry, but just goes through that same journey of your own sort of individual autodidactic thing. But it just happened to me much later.
Yeah.
Yeah, so that's...
So you were at Novo Holdings, I think until about a couple of years ago?
Yeah, I quit 2023.
Yeah.
So Matt Brown, I run a firm called Kalakau Avenue out of Sydney. It's a 10-stock long-only firm. So similar, I have a bit of an eclectic background too. But Rob, some of us butterflies, we just stay in our cocoons a little longer than others. And so I actually started my career as an Air Force pilot in Australia. I then switched over to an investment career after doing some study at Oxford University. I actually started on the allocator side, so I joined a firm in California, which was an endowment fund. Went to business school, and then I met a large single-family office in London who had just liquidated the family business, and we're building an internal team. I spent almost a decade there helping to build the global endowment portfolio. And it was really there where the strategy for Kalakau Avenue came to light. I think it's no coincidence that the strategy really reflects a long-term family office mindset. And I guess how I got motivated to do it is I was meeting with all these amazing managers around the world, learning from them, being inspired by them. And I noticed that in these meetings, all I wanted to do was chat stocks. And I was doing all this stock research just so I could go in and have these really productive conversations with the managers. And after a while, I realized I wanted to do it myself. And so I built the stock research process at the family office, and we ran a pilot portfolio for 3 years that was backed by my personal capital. And long story short, decided to spin out and launch my own business. When?
Roughly was...
Yeah, so the strategy's been running since the start of 2019, but I launched the business in 2023. Yeah.
Perfect. What was more stressful, being a fighter pilot or investing in the stock market?
Yeah, I think it comes back a little bit yesterday to what you said about temperament. And yeah, I think in both scenarios, it's different levels of stresses and different types of stresses. Yeah, but I've certainly had my times in the cockpit, where I've come back. The flight suit's been completely drenched with sweat just because of being in some pretty high stress situations. But there's nothing you can do except remember your training and your process.
Well, I was going to say at least the feedback loop is faster if you're a fighter pilot, but unfortunately you don't get a second chance.
Yeah, that's right.
Mark, why don't you continue?
Yeah,
and thank you, by the way, for sorting out the music.
Yeah, hi, I'm Marc Hormann. Hi, I'm Marc Hormann. I actually started my career in management consulting, as you know. And I caught the entrepreneurial bug quite early, so I actually built my own consulting company, which was acquired by Oliver Wyman in 2010. And until then, investment for me was really a hobby, which I think over time, at least at that time, then turned into a passion and then into a wish to do this full-time and also professionally. So when I exited consulting, I realized two things. One is, although my investment approach was producing very good results for myself, it wasn't yet a really refined and honed investment strategy which you could offer to others. And the second thing was that, money management is all about trust. So you need to have people who actually trust you so much that they give you a significant amount of money. And also at that time, I didn't have that network. So I chose to join a family office, a single family office, which offered me a lot of freedom to develop this investment approach and also the network. And I was very fortunate because in the family office, there was Andreas working at that time. And Rob had an office next door, so I felt like I came into the right place. And especially working with Andreas on a day-to-day basis for over a year was really insightful, and I enjoyed that a lot. And I don't know where Andreas is, but thank you very much for that time. And then the third element was that I met him actually here on your event in 2018. My business partner, I found a tremendous, great business partner in Stefan Rueff. We formed our relationship. He's a great investor, also with a great network, and he also had a legal setup already, which was suitable to launch a fund. So in 2025, very recent, we felt comfortable to start the journey. We got a tremendous, nice entrepreneurial investor base, so a lot of entrepreneurs like us. And so we started with, 80 million in the fund and 35 million in managed accounts, which I thought is a good starting point. And so I'm very excited about 2026, and the company is called 1OC.
Awesome, fantastic. So I'm going to ask each of you a little bit about how you invest, just to mix things up a little bit. Matt, would you like to go first this time?
Yeah, sure. So yeah, we're a very concentrated 10-stock global long-only strategy. It's focused on owning high-quality businesses for the very long term. That's usually overlaid with looking for thematics with secular tailwinds, and then finding the sort of marriage of those two things. If I had to think about one thing...
I can't resist asking, so what are the themes you're excited about at the moment?
Yeah, so if I think since starting the fund to today, the gift that's kept on giving as I was building the portfolio in 2018 has been the transition to the public cloud. That started out with businesses like Microsoft, etc., but as I went through the entire IT stack, you could just find a whole load of different areas as different industries were being re-put up for grabs in the public cloud environment. There's some themes in the portfolio that would be very obvious, and you might say, okay, well, they've been around a long time, but they're really only in their fifth or sixth innings and still have a long way to go. So I still think that's the case with digital advertising. I still think it's the case with digital payments. And so yeah, there's a number of different themes in the portfolio.
It's super interesting. I think it's a much more of a modern take on value investing. I guess if Warren Buffett were here, he'd probably say, I invest in things which I understand they were the same 50 years ago as they will be in the next 50 years, but you're trying to jump on these transitions.
Yeah, I wouldn't say so. I think that's a really key point, because I think one of the defining things of the strategy is, and maybe a little different to sort of other investors focused on thematics as well, is that I'm not trying to predict the future with a whole lot of certainty. Instead, I spend most of my time identifying characteristics of companies that I can know today that will give that company a better chance of success no matter what the future unfolds. The thematic piece for me is much more around a belief that a general growth tailwind behind a high quality business gives a quality business so much more optionality to surprise you in ways that you never thought would eventuate.
Awesome. We're going to ask for some examples a bit later, but Marc, why don't you talk a little bit about how you invest?
Yeah, so 1OC, so the company name is actually the symbol for one of centum, which is 1 of 100 or 1%, and this is basically based on our insight that most of the wealth, long term, the generational wealth actually gets created by a very few number of companies. And so we call them the 1%er companies, and I have looked for them over the last 7-8 years.
Yeah. Just to interrupt, I think that's such a great point. I keep seeing these sort of diversified, sort of active asset managers saying, oh, it's not fair if you didn't have NVIDIA, you couldn't beat the market, or it's not fair if you didn't have company X, Y. But it's always the case. It's a very small number of the companies that beat the market, right?
Yeah, absolutely. And I think there are even statistics that I think 1% of the number of companies are responsible for 80% of the outperformance, and then 4% are responsible for all of the outperformance. So you have to find these companies in order to add value, and that's really the concept of our investment process and the investment research and also the portfolio. And so most of these companies, and it sounds now very obvious, but we are looking for companies with great products and great services who show a lot of organic growth. So we are not so much a fan of acquiring a lot of things and then buying them together. We look for very powerful platforms with good margins, and then most importantly run by real entrepreneurs. And really great people. And I related a lot to what you said yesterday, it's very hard to distinguish good from, just good or a little bit better management. But I think when you see someone really great entrepreneur, it strikes you within 2-3 minutes when you meet him. And that's the type of people we are looking for, and we would like to partner with, and we would like to be shareholders with for the long term. All our investors are very long-term oriented and also understand this approach because they have been entrepreneurs themselves. So we feel very comfortable with that. And I think therefore the company name is also
I guess a lot of, I'd say, more traditional value investors would say, agree with all that, but if the company trades at more than 10 times, 15 times, 20 times earnings, I'm out. Is that the way you would think about it, or do you think that would potentially mean you miss too many of these sort of 1%ers?
It's a great question. No, I think in terms of two questions. So one is this a 1OC company? And then I want to know it, and I want to know it as early as possible, because the real wealth gets created when you find them early on. So that's one, and that's basically the list of 1OC companies we are in contact with, and we also enjoy the contact with. And then the second question is it too expensive, or is it still reasonable that it offers a decent return? And I'm in line with Andreas. I think he mentioned it briefly yesterday. He's looking for 15%, and very often when you find these companies, it's hard to envision 15%. Very often they trade your numbers, you get 10 or 12%, or they might be totally expensive.
15% compounding earnings.
Yeah, compounded, exactly. So you have to be a bit patient. Sometimes they are offered to you for a higher return, and then we want to buy them. Sometimes they just stay very, very expensive and we never buy them. And sometimes we also don't need to be too scientific about it. Sometimes when you can calculate 12 or 13% on reasonable assumptions and you really have a great entrepreneur, they tend to surprise you to the upside. And you might otherwise, if you are too scientific on your numbers, you might miss a great opportunity for long-term wealth creation. So that's how we think about it.
Awesome, thank you. Simon.
Yes, so I only invest in public equities now. In my prior job, I invested in both public and private equities. So I have a concentrated strategy. I think I have actually one thing in common with you. I'm not sure if you would describe it this way, but I usually say that I have a heart filter on passion. So I want people who are the people driving the companies who are really sort of internally motivated and really kind of love the company in a way that you could not imagine them doing something else. And sometimes that lead me to invest in companies that are, well, the people are maybe so passionate that other people would say that they are maybe borderline crazy.
We're going to get to that.
Yeah. So and then the second criteria is I focus a lot on scale advantages on either the demand or the supply side, so either network effects or cost advantages, not because I believe that those attributes make necessarily a company better than other types of companies, but more because I have like a process around that, that I believe that I can use across different industries and situations.
If I could just interrupt there, I think that's also somewhere where modern value managers like you maybe differ a little bit from the sort of the more traditional canon. I think someone like Warren Buffett would say the important thing there's a moat. But there's, of course, lots of different sources of competitive advantage, and you said of all of them, you prefer the economies of scale and the network effects.
Yeah, I prefer them, not because I think that they are better, but just more because I have a method to analyze it. And then within this sort of universe, what I typically do is I kind of underwrite an investment with typically like an 8-year horizon, even though it's kind of just an imaginary thing. Like I could sell it before, I could sell it after, but it's kind of like just my method. And imagine an exit 8 years out, and then a spectrum of outcomes. And I have this concept of state preferences, like Arab state prices and so on. So my subjective thing that I would like to see is that across the sort of perceived spectrum of outcomes that is in my head for this particular company, that I believe subjectively that the risk that at year 8, if I exited, that it would be worth less than what I paid for it today. My tolerance for that is just very, very low. But at the same time, I want like a decent chance of optionality of like multi-bagger outcome. And maybe focus a little bit less on sort of the median case of outcomes or the base case that maybe other people who are like, what's the upside to it? And that's not really my approach. I want optionality and reasonable downside protection.
Yeah, awesome. I think also those two modes, what I like about them is as the competitive advantage to the company grows, the value to the customer grows, which isn't necessarily the case with those other modes, so maybe makes them more sustainable. So maybe each of you can give an idea which sort of illustrates a little bit how you think about the world and the type of investments you make. Mark, why don't you go first?
Okay, so I will mention a company, I think, which illustrates our thinking very well. It's called MedPace, and it was...
Just to get the name properly, it's
MedPace. M-E-D, and then Pace.
Okay, got it.
Yeah, MedPace. So whenever a biotech or a pharma company wants to launch a new medicine or a new treatment, they need to get approval and need to get it studied, and they use contract research organizations for that. It's a pretty consolidated market. It's growing since years. And we find it quite interesting as an industry because of this tailwind and new technologies leading to a faster finding and development of different compounds. So the need for these studies goes up. So we looked at the industry, and what you will find is it's pretty consolidated, and most of the players look the same. So they have a bit of growth in line with industry trends. They have a 10% EBIT margin. The management is okay. So nothing to really criticize, but also nothing to get too enthusiastic about it. And then we found MedPace, which was founded, I think, 1992 by a strong entrepreneur called August Trundle. And in this kind of market, he's growing organically more than 20% per annum, and he has a higher margin than anyone else. So the EBIT margin is 50% higher than the industry average. And he is offering the services cheaper than the competition. So, he must be doing something right. So we studied the company, and then what you also see is that August is not only the driver behind the company, he's also a pretty smart capital allocator, because the stock price has been a bit volatile, and whenever it came down, he not only bought stock for himself, but he also bought stock for the company. They have no debt, so everything financed internally, actually net cash, which he deploys from time to time very smartly into stock buyback. So it's clearly a 1OC company in an interesting industry.
Yeah,
and
one of the mega trends in that space seems to be increasingly sort of Chinese biotechs developing molecules. Is that a tailwind or a headwind for them?
No, I think that's probably a tailwind for them. The other part, which also sometimes get misunderstood, there are new simulation technologies, and a lot of investors got worried a lot by an FDA announcement that they are going to consider these studies. But all these simulation technologies are actually developed by the incumbents.
Okay.
Yeah, so I think that's going to be, again, a tailwind for them, and it's actually increasing the moat. And there are no newcomers. I mean, it's a total regulated environment. You have no chance as a startup or a newcomer. So I think that's why the case is quite good, and we would expect, August being able to grow double-digit. There is no reason to assume why margins should go down. The price is reasonable. Almost all profits are cash flow, so we like the case.
Perfect.
And he has 20% of the company, which equates to $3 billion. So I think his incentives are clearly aligned with ours.
Perfect. Yeah, Matt, would you like to continue?
Yeah, great. I think a good one is CCC Intelligent Solutions, which actually was just bought recently. It'll be out in our letter in the next couple of weeks. Now, this business we came across after some work in the insurance space. So we were underwriting Guidewire sort of 3 or 4 years ago. And then just as we're speaking with insurance customers, we would say, hey, what are the other industries or suppliers that are fairly monopoly-like? And so names like Copart came up and CCC Intelligent Solutions, and so we started looking into those as well. So what CCC does is they're essentially a vertical software business for the claims management process for auto physical accidents in the US. They have 75% market share. They also do a little bit on casualty, disability, workers' comp, etc., related to automobile accidents. And what really struck me about this business, so it has all the typical moats that you'd expect in a good entrenched, dominant vertical SaaS player. They have very high switching costs. They have very entrenched sales and distribution relationships. But what it has that other vertical software doesn't have is a network effect laid on top. So they actually sit as the conduit between the insurance companies and the repair shops. And there's like 300 insurers, over 30,000 repair shops in the network and using the platform. So we found that really interesting. The opportunity came about. There's a private equity sponsor that's getting out, and that caused the share price to tank. And had underwritten it for probably 12 months before actually buying it. I think it's one of those.
If I can interrupt, is it a concern for you that there was prior private equity ownership? In the past, I've found companies have been stripped bare, underinvested, and you only sort of realize it, in a year or so after you invest.
Yeah, I think absolutely. It was a concern, and so that was a key part of the diligence was understanding how the private equity sponsor had interacted with the company, and it wasn't the first PE sponsor either. There's a history of this company being public and private, but we got a lot of confidence. One of the areas, like the management team, so the CEO has been CEO for over 20 years, almost 30 years. Before that, he was CTO with a strong engineering background. And he's been with the company through that whole thing. And so each of the PE sponsors that have come along, I think, have really backed him and his team to really lead this company in the way he sees fit, and have kind of maybe more been along for the ride, which I think has been a good thing. But it also, it fits into the software landscape. We've noticed that as software businesses drop from sort of 15% growth to sub 10%, the shareholder base tends to turn over, the stock gets punished, and it becomes like a low growth company. But I actually, 9% CAGR revenue is what I'm expecting for this business over the next 5 years. At the right valuation, I think that's pretty attractive. there's certain areas for margin expansion. I think that takes free cash flow compounding to about 15%, and you're buying it over a 5% free cash flow yield. So the IRR is anywhere, depending on your exit assumptions, is anywhere between sort of 15 to 20%, which you feel is pretty attractive for a dominant business. Yeah.
Great. Then I'll turn to Simon. I'm curious which of your crazy man stocks you're going to choose.
I'm going to have to evade your question a little bit because I have the self-imposed policy of not pitching stocks in public. But okay, I'll give you this. So in the past, when I have been at like a stock pitching event, I have this one company that I have really enjoyed pitching, mostly because of seeing sort of the immediate allergic reaction in people's eyes, and that company is SoftBank.
I was hoping you were going to say that.
Yeah. And but I've seen this pattern, this sort of individual journey that people go through that I have been through with SoftBank, where at first you think, the guy is crazy, right? I read in the Financial Times that he compared himself to Jesus Christ, the Son of God.
We're talking about Massa.
Massa, yeah. and so you have this sort of, I have this sort of, and he's, so in psychology you have something called stigmatization, right? Mm-hmm. And you have this here too, the guy is stigmatized. And it's almost like when you say it in a value investor forum, you say, I like Massa. People are like, what's going on, right? So there's this barrier. But then what I went through with him, and what I have then encouraged other people to do and seen actually, is that, okay, so you have only consumed probably the second order information about Massa, right? Yeah. Most people have. So I say, okay, try go on YouTube, see the 1-hour press conference he did after he acquired ARM. See the interview we did with David Rubenstein. Just see him, read some of his letters. His letters are really crazy. And then judge him based on sort of your own judgment, not through some weird Financial Times filter. And what I've then noticed is really a lot of people come back and you're really right. I'm really surprised that this would happen because I did not expect that would be the outcome. But why it fits in, I don't know. I would like actually to avoid answering the second part.
Totally understand. And we've spoken in the past a long time about SoftBank, and my reaction was initially very allergic, like probably a lot of other people's as well. And I didn't get over the line of thinking this is something I would invest in, but you definitely changed my mind that there's a lot more to it than just the Financial Times sort of thing. Yeah. So I know all three of you think a lot about AI. I want to keep the question sort of super open, so take it wherever you want. But what type of investment opportunities that's creating, what type of opportunities it's creating for your own workflows, take it in whatever direction you want to. Time is a little bit short, so maybe just pick one topic and talk about it in whichever direction you want. So Matt, maybe I can start with you.
Yeah, wow, that's a big topic. I think, look, when it comes to AI, I think like a lot of it's unknown. It's really hard to have conviction. But I think there's a few things. Like one, I definitely have conviction that the productivity gains from AI are real. I definitely have conviction that there's real AI demand. I think the biggest current demand is like what Andreas and Rob were talking about yesterday, which was improving the existing tech businesses, so in Meta and Alphabet in particular. But increasingly, like you see it on earnings calls, whether it's with the AI providers, the software companies, all the real economy, there's demand to like figure out how they can use this. So I think there's definitely opportunities. I think that on the same side, I think the stats are very well known as sort of 5 to 7 trillion in capex that's going in over the next 5 to 7 years. I think there's going to be a huge overinvestment. There's definitely going to be pullbacks. And whether that's a bubble or not, I don't really know. I don't look at things from a macro perspective. From a bottoms-up view, so I own Meta, Alphabet, and Microsoft in different sizes. And to sort of build on some of the comments yesterday from Rob and Andreas, the quantums of excess capex is huge, right? So Meta is going to go up to about 40% of revenue on capex. I think Microsoft around 37%. Alphabet, by my estimates, probably around 24, 25%. And there definitely needs to be some very large revenue increases to justify that capital spend. Now that changes depending on whether that excess capital spend is in perpetuity or whether it's sort of what Andreas said, which is where you sort of build out and then the CapEx tails off because you now have this infrastructure. And whether that comes to fruition is hard to know. I think my view, and I think what the company's view is more thinking about that quantum in percentage of their market cap. So for Meta, I think it's around 12%, Alphabet 5%, Microsoft around 8%. And I think their bet is to say, well, I'm willing to sacrifice 12% of the company today to not be left at the altar and have these, potential value creation opportunities. The last, just one of the really cool opportunities, and then I'll hand it over. Say for Meta, for instance, so as soon as Gen AI came out, and one of my interns was working on this with me in the audience here, was looking at like how, and is it possible for Meta to expand its reach in its algorithm to basically cannibalize a huge chunk of the ad creative industry? That makes a ton of sense for advertising to come into the algorithm in terms of the actual content generation. Like to get to the point, this panel here, like we're all sort of, males in finance, maybe we're a key target for a sports car or something like that, but maybe, my favorite color is red and I like the beach, maybe Rob is blue and he likes driving in the mountains. And it should be real time that ad is changing and being customized to that individual at that level and have that feedback mechanism. I think that's, it's one potential. There's a lot of technical limitations why you can't actually do that fully today. But that's like another opportunity where that TAM for the digital advertising industry can have a step change increase, and that it would make sense for that to be captured by somebody like Meta. So we'll see.
Yeah, it's a great idea. You could even theoretically, if someone opted into it, a clothes, the ad be with their own image.
Yeah, absolutely. Yeah.
Cool, Simon.
Yeah, I don't think I have so much to add in relation to what you said yesterday. I'm a little bit confused when people talk about an AI bubble because, first of all, what do they mean by AI and what do they mean by a bubble, right?
Yeah.
So AI, do they mean the whole market in general? Do they mean semiconductor companies? Do they mean hyperscalers? I'm a little bit, and bubble, do they mean that it's overvalued relative to the fundamental value if you discounted the cash flows, or do they mean that there might be like a future where it's really big, but it might just go down in the short term? So I'm a little bit confused about. I'm kind of exiting that discussion. But I really started thinking a lot about how I can avoid companies that would be somehow victims of AI. I really think a lot about that. So that's actually probably where it's most important to me.
Yeah. Any obvious ones that spring to mind, or sectors? Or?
I don't know. I don't know which specifics to mention, but I just think about it all the time. I'm thinking about it in relation to any company I'm looking at.
Yeah, I think that's a great mental model. Charlie Mug always said to invert, and a very formative experience for me was investing in the end of the 1990s in the dot-com bubble. And it was actually a pointless exercise to try and pick the winners because the winners weren't even started, apart from maybe Amazon, but apart from Amazon, the winners like Meta, Google, they were only started years later. But there were for sure lots of companies got destroyed in that period. So that's a great way to think about it. Mark?
Yeah, I think a lot about timelines. So you remember the dot-com bubble, and I also remember it. And I'm not saying it's a bubble now, but at that time when internet came up, everything was internet, and we were all supposed to do everything over the internet within 12 months. And history showed it was a bit different. So all the predictions and forecasts came true, but only after a couple of years and much later than anyone thought. So, and I think it could be similar this time. Maybe the cycle is quicker because everything happens quicker, but I think that a lot of the predictions need time. And I know that from my former life as a consultant, whenever you go into normal companies, let's say not the tech companies, it's very hard for them to do implementations and to implement new technologies and to make it useful, so it takes time. And that is also where we included into our investment research. So like Andreas said, we want that AI makes the products and services of our companies better. So we ask them how they do that. And the second thing is that they use AI to gain efficiencies. And then the question is, who is capturing those efficiencies? Is it the end clients who will ask for lower prices, or is it really the company which can translate AI into higher margins? And that basically is the two questions we try to answer today for our portfolio companies.
Yeah. Is it something that worries you that, going back to the 1990s analogy, the really the 1% companies weren't the ones that existed in the 90s and figured out how to use the internet? It was more like the companies that were later founded with the assumption of the internet built into their DNA.
Yeah, I mean, that is a very, very good question. I mean, we are constantly scanning for new evolving 1OC companies. And the only comfort I have is I don't believe that we will probably find every of these companies very early, but history shows that it's also okay to find them after 3, 4, 5 years, because you are just at the beginning of a long journey of value creation. Yeah. So we just strive to be as early as possible, but
yeah. Well, in the case of Carvana, there was an opportunity to buy it at a Series A valuation in 2022, but we weren't going to.
Somehow I didn't. Yeah, absolutely.
Okay, so we're on time, but I'm going to let it overrun for 5 minutes because we lost a bit of time at the beginning. The question I would like to finish up on is, you guys congratulations, started funds over the last, I think in your case, 1 year, maybe 2 or 3 years, also in the last 1 or 2 years. What advice do you have for people who are kind of sitting here in the audience today, either thinking about making the jump or maybe very early on in making that jump? What would be your advice to them? Simon, maybe I can start with you on this one.
So I think I had a great advice before I started by a very successful Swedish investor who's in his 80s now. He built a very big investment firm, and he gave me just this one advice: don't get divorced. and so but that happened to him, right? So I had this long conversation with my wife prior to starting, because it is really hard. It has been hard, I must say. It has been hard. And so my family was kind of involved in the decision to do it. But even though my wife knew what was going to happen, if we bring her on stage, she'll probably also say, yeah, it was pretty hard. So I think that's definitely one. And I would also say, especially like me, I come from a small country. I come from Denmark. Yeah. So on all the whole setup thing, don't generalize from the kind of advice you get from people in other jurisdictions on how your setup should be, because it can be quite different from country to country. And also don't assume that when you hire like advisors, that for instance, legal advisors and so on, that they necessarily have all the practical. Like in Denmark, it's not so common to have a public equity strategy and private markets vehicles types things. So if you come from a small country like me, maybe it's not that plug and play to just go take this off the shelf. This is how you start. While if you're in America, but so that would be my advice, and also realize that you're running a business. I seriously think so. About 1 year in, I kind of realized I'm actually running a business. This is not some bizarre performance art project. This is actually like a business. And there's a lot of great books on entrepreneurship and that are quite relevant when you're running an asset management, investment management company.
Yeah, that's great. Just going back to your first point on don't get divorced, are you going full Jason Huang on us? If I'd known what this would have evolved, I would have never started, or are you not going quite that far?
No, it's going fine. I think it's going better. I think my wife will have to answer.
We get her up here next year. Great. Matt?
Yeah, I think probably in order of priority, I think number one is give yourself the longest runway possible. And so that I think that means being like ruthless around the costs that you put into your business. I think launching with all the top tier 1 providers, with your Cayman Master Feeder, etc., is fine if you're launching with 200 million plus. But for most emerging managers, you're typically launching with something smaller than that. And to give yourself that runway, there's many ways, I think, that you can keep your budget extremely low. Like, you don't need an office. You can keep things as simple as possible. There's ways that you can do a structure where you don't need a fund administrator and these types of things that just layer on, more and more costs into the equation. So that'd be number one. Number two, I'd say, and this is going to be very individual, is like, make sure you're doing it for the right reasons. It's easy to look at all the successful managers that have made tens and hundreds of millions, and if your aim is to go into this with the idea of making tons of money, I think that's just the wrong mindset, and you're going to be disappointed early on, and you're probably going to not be able to go the long road that it sometimes takes to scale a fund. It's fine to want to make money out of it, but you first and foremost, it needs to come from a driving passion to be doing your stock picking or whatever investment strategy it is. But also that you've got a desire to be the person controlling the decisions, that you want to be, that you get a fulfillment from being the person who's actually in charge and running the business and running the portfolio. Those would be the two biggest.
Yeah, I think the one on the runway is such a great point, because I think some managers think they have to, in order to, exude credibility to the outside world, have big offices and the best service providers, but of course that just shortens your runway, because you're going to run out of money more likely than not.
Yeah, and I suspect, because I've been on the allocator side for a long time, right? So I've underwritten some wonderful managers over the years, and I know from my own mindset and from a lot of my wonderful allocator peers, if they're going to say no to you, they're probably going to say no irrespective of whether you have Morgan Stanley Fund Services, which is the premier custodian, or you have a cheaper custodian. They're interested in you as an individual. And I guess just as it comes to mind, the third piece of advice, and it sort of hits maybe Andreas is the champion of this. But you can, and it sort of feeds back to keeping your costs low, you can be ruthless in automation so that you can keep your employee count. I'm a solo, it's just me in the business at the moment. And I can do that because everything on the operations side is just ruthlessly automated. My clients get their reports before I even realize, that they've gone out. So the only thing I'm spending time on is writing the letter and, putting that on the website. And there's just, things that you can do in your business just to keep it as simple as possible. As soon as you introduce complexity, then you introduce, more people, more man hours. You need more farm under management. And it sort of snowballs out of control.
Perfect, awesome. Mark, you have the final word.
I would have basically two topics. One advice would be to really, sharpen your message around what your investment approach is. So I meet a lot of other fund managers, and when I ask, okay, what are you doing? And then they explain this and this and this and this, and then I get lost of what they actually try to do. And I think a lot of investors who are not, thinking about investing every day, then they cannot understand what you're actually trying to do. And the other sign is if you can't explain what you're doing, it means you haven't thought about it enough, because usually when you know what you're doing, it's pretty simple as a message. So that's why I needed so many years to actually think about that and try to sharpen my investment stories. That's one. And the other one is, try to be selective about the partners you are looking for who give you capital. I think that's very important, because it can make your life very, very hard. So I'm very fortunate that I found a lot of good partners which have the same ethical values, kind of same personality, the same vision, and the same goals. At least I believe so. So that's very important. And in line with that, in the past, 20 years ago, fund managers used to start with, 5, 10 million, whatever it was. Money is not as valuable today as it was at that time. So I think that threshold actually has gone up, at least in Europe, where you have a lot of compliance, a lot of regulatory cost. So I think if you want to be successful and make a living out of it, this threshold has gone up a bit. And so you need to ask yourself an honest question. Are you able to raise this type of money so that you are successful or can be successful, or is that a too high ask?
Perfect. Thank you all so much. That was a really wonderful session. One of the best we've had, I think. Yeah. Mark. Thank you. Really awesome. Really great. Thank you.
Yeah, thank you.
Thank you so much.